Plenty of stocks are trading at record highs. In fact, the S&P 500 seems like it makes a new record on what is a monthly occurrence. But not all stocks are working. And in fact, in today's video, we're going to be taking a look at 4 stocks that are trading at or near their 52-week lows. After all, the name of the game is to buy low and sell high. And all 4 of these companies are definitely trading low, but it doesn't mean they can't go lower. And in today's video, I'm going to detail out my target buy price and what my rating is for each of these companies. But before we begin, do me a huge favor. Show your appreciation by clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 4 stocks trading at their 52-week highs. Beginning with stock number 1, which is going to be Celsius Holdings, stock ticker CELH. Celsius operates as a beverage company, but more specifically, they are a healthy energy drink. The company has been public for nearly 2 decades now, but really didn't start garnering attention until the pandemic hit and the stock went parabolic at that time. Looking at this chart here, you can see that Celsius shares from May of 2020 through May of 2024 increased over 5,600%. How's that for some growth? However, with growth usually comes volatility, and from that point in May until mid-November, shares have crumbled more than 70%. Are we getting an opportunity with shares trading at 52-week lows and trading at a share price that we haven't seen since July of 2022? Well, part of this downturn is due in large part to their close partnership with that of Pepsi, who bought into the company a few years back. What happened with Pepsi is, what that management team says happened, is that Pepsi over-ordered a few years back, and they're still processing through a lot of the inventory that they already have. Did they already order too much, or is the product just not selling as fast as they thought? That's the question we as investors need to ask ourselves. Celsius is still a great growth story though, as they have single-handedly grown the energy category, making inroads in terms of market share. Speaking of market share, Celsius makes up 12.1% and is the 3rd largest brand within the energy drink sector, trailing only Red Bull and Monster. This stock has plenty of risk associated with it, so it's definitely important to understand that before getting involved. Now let's take a look at valuation, where we can see that earnings over the next few years, analysts are still expecting this company to grow at a strong pace, growing at 39% next year and 27% the following year, giving the company a forward PE multiple of 26.5 times, and they currently trade with an EV to EBITDA of 24.9 times. When it comes to Celsius, I rate this stock a moderate buy. It has been in free fall mode, so I always take the approach to be a little bit more conservative. Let's wait to see the story reverse, which means I'm not necessarily going to catch the exact bottom, but I'm for sure not going to catch a falling knife. So I would probably wait till we get to the lower $20 range before looking to add to a position in Celsius. And that leads us to the second stock on our list, which is going to be the Hershey Company, stock ticker HSY. When it comes to Hershey, they have a lot of headwinds that they've come across the past few years. The first being the introduction of GLP-1 drugs, and at the same time, the sky-high record price of cocoa beans. This is a double negative for the chocolate king. However, this is an iconic company that's weathering the storm, and the stock is currently sitting at a new 52-week low and trading at levels last seen in 2021. The company currently has a market cap of $34 billion. This company is a great example of a high-quality company trading at a great valuation, but it's not something that's going to get you rich overnight. You're not going to get rich quick with shares of Hershey's. There's still plenty of headwinds, but this entry point allows you time to build a position in the stock for a little bit, and you're going to get paid a dividend to wait, and I'm going to show you more about that here in a second. First, though, let's take a look at some of the internals. And despite the headwinds that have plagued the company of late, they're still generating solid amounts of free cash flow. In fact, their operating cash flow is the highest in the history of the company, with free cash flow sitting at $1.65 billion. The balance sheet could definitely use some help as they do not have the strongest balance sheet, but current valuations are very intriguing. Growth is expected to return in 2026 from an earnings perspective, but in terms of EV to EBITDA, shares trade at just 14.8 times, which is the absolute cheapest you've been able to buy this stock for more than a decade. The valuation seems to have a lot of the risk already priced in. Again, the growth isn't going to come right away, but at a low valuation, a high quality company trading and operating with high margins might be a great entry point. Now let's take a look at that dividend, where you can see the company currently offers a yield of 3.2%, and they've historically grown their dividend at a strong clip with a 5-year dividend growth rate of 13%, and they have grown their dividend for 15 consecutive years. This is a fantastic company and a clear leader in the industry. So what do I rate shares of Hershey right now? Well, when it comes to Hershey, I rate them a moderate buy. And the price target that I'm looking to enter into a position and buy shares of Hershey at would be closer to roughly $155 per share. And that leads us to stock number 3, which is going to be ASML Holding, stock ticker ASML. This is a company that has been put through the ringer over the past few weeks. It started with them accidentally issuing their Q3 earnings a little early, a day early. But when the full report came out, they had missed analyst expectations and the stock was already cratering. Outside of the less than stellar earnings, there's also some growth concerns. And there's also concerns about their reliance on China, especially with the Trump administration coming back into power. The company currently trades with a market cap of $262 billion, and over the past 12 months, shares have decreased by 5%. As I mentioned, there are some concerns as it pertains to slowing AI growth. But again, chip manufacturers and the equipment manufacturers are two different companies trading with two different cycles. So you can't look at the likes of NVIDIA, the likes of Taiwan Semi, and expect that to fall over into the likes of ASML or Lam Research. These are bought way in advance at much different timings. And when you look at the demand that goes across all of those chip manufacturers, the number one problem right now is lack of capacity. How do you increase capacity? You increase the amount of equipment that you have. What does that benefit? It benefits a company like ASML. When it comes to the financials, the company still maintains a decent balance sheet with a current ratio at 1.55 and a quick ratio sitting at 0.73. However, valuation is starting to look quite intriguing as the company trades with a forward PE multiple of 27 times, well below their 5-year average of 35 times, and their price to free cash flow multiples at 28.3, again well below their 5-year average of 38 times, and the lowest multiple we have seen since 2018. The PEG ratio sits at 1.2, and they have an EV to EBITDA of 27 times. Again, well below their 5-year average of 35.5 times, and the lowest we have seen again since 2018. So great valuation entry point as it compares to their 5-year average. The company also pays a dividend that yields 1% with a strong 5-year dividend growth rate of 23%. So where do I rate shares of ASML? I would rate them a buy. And when it comes to a price target, if you wanted to get more specific in terms of what price am I actually focusing on buying shares of ASML, it's going to be closer to that 608 to 625 range. And why might you ask? Well, when you look at this stock chart right here, you could see an unfilled gap between that 608 and 625. And the saying goes, gaps always get filled. So roughly another 10% drop from current levels is not all that far. And that leads us to the fourth stock on our list, which is going to be the Coca-Cola Company, stock ticker KO. Not that often do you hear about shares of Coca-Cola trading at or near their 52-week low. But that has been the case here with a drop-off in shares of roughly 15% over the past month alone. One of those headwinds is very similar to what we just talked about with shares of Hershey and the introduction of those GLP-1 drugs. But I felt like management has done a fantastic job weathering that storm early on. Looking here at Coca-Cola, you could see that they currently trade with a market cap of $266 billion, and over the past 12 months, shares of KO are up 8%. When it comes to Coca-Cola as a company, it is a very high quality company, and analysts respect it a great deal, as it is one of the least shorted stocks on the S&P 500. And when you're looking for the next growth catalyst, it's going to come by way of emerging markets where they continue to see solid growth and continue to see inroads across the globe. Coke is a global company. I spoke earlier about one of the headwinds being those GLP-1 weight loss drugs. Another headwind has been the strong dollar, as this is a global company. But as that dollar weakens over time, that's going to be a huge boost for this company right out of the get-go. Business is certainly not slowing, as revenues have grown from $38.6 billion in 2021 to more than $46 billion over the trailing 12 months, with operating income growing roughly 20%. The company still maintains a decent balance sheet with a current ratio at 1.06 and a quick ratio sitting at 0.8. In terms of valuation, I'm starting to like what I see. Analysts are looking for the company to generate EPS of $3 flat next year, which equates to a forward PE multiple of 20.6 times, which is well below their 5-year average of 23.5 times. EV to EBITDA sits at 20.5 and in line with the company's 5-year average, so I definitely would like to see it cheaper there. From a technical perspective, RSI is sitting below 30, which looks fantastic, but the stock is trading at a key support level, and if it breaks below that, we could see a decline of at least another 10% or more into that mid $50 range. As such, I'm going to be a little bit more patient here with shares of KO to see how this plays out over the next week or so before deciding to nibble around the mid $50 range. So there we just looked at 4 companies trading at 52-week lows. And if you like this type of research where we dive into stocks a little bit more deeper, then definitely check out my newsletter, The Stock Investor's Edge, where we give you a macro perspective of the market as a whole. And for those that sign up for our premium subscription, we do individual stock deep dives, just like this, but on a deeper level. You also get access to my entire portfolio. You get trade alerts and our monthly quick picks. So definitely check that out down in the description below. And in the comment section, let me know which of these 4 stocks do you own in your portfolio. And if you haven't done so, please hit that like button down below and show your appreciation for these videos. Subscribe to the channel, and we'll see you in the next one. Take care.